Hi and welcome. If you are intimidated by personal finance or financial terms in general and you just want a little bit of help, a little knowledge to start out, this is the episode for you. Welcome to Phil's Finance. Today I've accumulated some of the most commonly searched for finance or personal finance terms, and I'm going to break them down for you and define them. So, first on the list is loan. Now, a loan, it could be either you've gone to a bank and you're trying to get a mortgage or a personal loan or an automobile loan at a dealership, and they're all going to have three basic components. Number one would be the principal. That would be the amount that you are borrowing. So if it is a personal loan for $10,000, the bank gives you $10,000. Or if it is an auto loan for $30,000, the bank has lent you $30,000. That is the original amount that you have borrowed. Number two is the term. Term would be how long is it? Is it a car loan that is 5 years, which is also called 60 months? Is it a 6-year car loan, which is 72 months? Or is it a mortgage, a 15-year or 30-year mortgage? Those are two of the three components. And the third and final one would be the interest rate. So people are not just going to give you money out of the goodness of their own hearts. There's going to be something in it for them. So whether it's 5%, 8%, or a credit card at 27%, it is the amount of interest. That is the price of borrowing money. With those three components combined, then you have a loan. Whether it's written on a napkin or a verbal agreement or a formal one, that is a loan. Next is APR, or annual percentage rate. You may have seen on a car loan or on a mortgage, maybe they're advertising 7% interest. And then you see that in the loan documents, the APR, the annual percentage rate, is maybe 7.2%. So essentially, the APR is the interest rate plus any fees that are financed. So while the interest rate may have been 7%, if it was a mortgage, maybe you financed a loan origination fee or processing fee or any other fees they have in there. And then that difference between the interest rate and the APR shows the amount of fees that were financed. And typically, the larger the gap between the interest rate and the APR, the more you have paid in fees. So if you have a 7% mortgage and a 7% APR, well, it looks like you've paid, either you've had no fees or you've paid the fees. Either you have had no fees or you have paid the fees out of pocket and only borrowed the amount for the item, such as house or car. Now, on the other hand, the next one, APY, is annual percentage yield. Now, while APR is the percentage rate that you are paying, that is the price of borrowing money, APY is the opposite. That is what you are earning. If you have an investment, it's a savings account, it's a CD, which is a certificate of deposit. APY is the annual percentage yield and is what you yourself are earning. Now that we have talked about APR and APY and the basics of what a loan is, now let's talk about how the majority of loans work, and that is the word amortization. Amortization is for almost every type of loan except for a credit card. Credit cards are revolving debt. So it's not going to include credit cards, but we're talking about almost every type of other loan, whether it's auto, mortgage, appliance, anything that you have borrowed money for. With amortization, your payment on your loan is the same every single month, no matter how many months you've been paying or how much extra you pay. For example, if you have borrowed $30,000 for a car loan and your interest rate is 7.42% and it is a 5-year loan, your monthly payment is $600. With that first payment of the $600, the money on an amortized loan always goes to only two different things. Now, I'm not talking about when you send a check to a mortgage company and they also have collected on your behalf for taxes and insurance. This is separate. Think of a car loan, think of any other type of loan. The money goes to two things. It is either principal or interest. And there's a split. And the thing with amortization is it changes the further you get into the loan. This is where most people seem a little confused. So back to the car loan of $30,000, 7.42% interest for 5 years. Your $600 payment has now gotten sent to Toyota or Honda or whomever you financed your car through. And of that $600, $414.50 goes to the principal. Means you now owe that much less for the next month. The rest of it, $185.50, went to interest. That's how the bank made their money. If you look at the next month, you still pay the exact $600, but now $417.06 has gone to the principal. So it's, almost $2 and 56 cents more. And now a little bit less went to principal, $182.94. Why is that? Well, here's the reason. When you went to make your first payment, that was based off the full $30,000 that you owed. That was your balance. So based off that, a certain amount went to principal, a certain amount went to interest. But now as soon as the bank, Toyota or Honda, as soon as they cash that check, things are different. Now you owe a little bit less. Now instead of owing $30,000 on that car, when they go to calculate payment 2, you owe $29,585.50. So for the next month, yes, you pay $600, but now a little bit more went to principal and a little bit less went to interest because the balance that they base that interest off is smaller. Now, the real key and the magic of an amortized loan is that any penny you were to pay over $600 goes directly onto the principal and to the principal only. So for that first payment of $600, if I instead had paid $700, well, instead of $414.50 to principal, it would have been $515.50 to principal. And that would change the whole rest of the amortization as well. Your payment is always the same, but you can certainly pay it off much faster if you pay extra.